Silver futures have reached a significant milestone, with Western futures closing at $94.30, a level that market watchers had previously identified as the next key technical objective. The move comes amid a broader rally across precious metals and hard assets, drawing renewed attention to the dynamics shaping commodity markets in early 2026. Silver has now recorded 10 consecutive monthly green closes, a streak that market analysts are comparing to the historic run that preceded the 1980 rally, during which silver climbed from $6 to $50 per ounce over an 18-month period. Gold has simultaneously posted its seventh straight monthly record close, the longest such streak since 1973, with Western spot gold currently trading at $5,277. In just the first 2 months of this year, gold has risen 22%, while silver has surged 31%. The rally is not confined to precious metals alone. Oil, gold, and silver have all moved higher in tandem, a pattern that analysts have historically associated with geopolitical risk pricing. Developments in the Middle East have added to market uncertainty, with the United States State Department publicly calling on the Iranian regime to cease the detention of American citizens and release all unjustly held nationals. China has separately issued an order for its citizens to leave Iran immediately. Against this backdrop, an estimated $650 billion was added to the precious metals market capitalization within hours, as these geopolitical developments unfolded. Turning now to the dynamics between physical and paper silver markets, a notable divergence has emerged that is drawing significant attention. Western spot silver is currently trading at $93, while Shanghai spot silver sits at $105, and Shanghai futures are priced at $108. That represents a Shanghai premium of approximately $12 over Western spot prices. Analysts note that when this kind of premium widens during a price rally, it signals that physical and paper markets are pricing two distinctly different realities. On the exchange side, the COMEX reported notable movements in its February 26th vault report. Registered silver on the exchange rose by 2.3 million ounces, bringing the total to 88.4 million ounces. Within that figure, Asahi added 824,000 ounces, Loomis contributed 964,000 ounces, StoneX added 307,000 ounces, and Brinks added 111,000 ounces. However, eligible metal on the exchange fell by 2.6 million ounces, dropping to 272 million ounces. The net result was an outflow of 306,000 ounces, bringing total COMEX silver to 360.3 million ounces. Perhaps more consequential than these daily vault fluctuations is a separate development in COMEX open interest on silver futures. Open interest has collapsed from 162,000 contracts approximately 1 month ago to 118,000 contracts currently. That represents a drop of 27%, and it occurred while silver prices were simultaneously climbing from the low 80s to $94. Market observers have pointed out that this combination is unusual, as participants holding winning positions would not typically exit those positions during a rally. The question being raised is which category of market participant is responsible for the exodus. The answer, according to available data, points to commercial hedgers, entities that use futures exchanges to manage risk on physical holdings. Reports indicate these participants are migrating toward over-the-counter markets, citing higher COMEX margins, deteriorating liquidity, and execution difficulties on the exchange. Earlier in the week, the COMEX also experienced technical issues that resulted in a temporary trading halt, a development that did not go unnoticed among market participants closely monitoring exchange operations. The implications of commercial hedgers exiting the COMEX extend beyond the exchange itself, affecting the broader market structure in ways that ultimately reach retail participants. When dealers are unable to hedge their positions effectively on an exchange, their ability to manage risk on their balance sheets becomes constrained. As a consequence, some dealers may respond by widening the spreads they offer to retail customers, charging higher premiums when selling physical metal, and offering lower prices when buying it back. This is not an anomaly unique to precious metals markets, but rather a documented pattern observed when businesses operating in stressed financial environments seek to compensate for increased operational risk. In that context, observers have raised specific concerns about storage arrangements offered by dealers in the current environment. When a dealer offers significantly discounted or complementary storage for physical metal, the business rationale behind that offer warrants scrutiny. Storage and purchasing decisions, financial commentators note, are two separate considerations and are best treated as such. A potential conflict of interest arises when the same entity storing a customer's metal is also the entity offering to purchase it back. In such arrangements, customers may encounter unfavorable buyback prices or extended waiting periods before receiving payment upon requesting a sale. The recommendation being highlighted is that investors consider working with a custodian that operates independently from their dealer, precisely to avoid this built-in conflict. Adding to the structural concerns is the current state of silver lease rates. Silver lease rates have reached 1.6%, a marked shift from recent historical norms. The average lease rate was positive 0.04% in 2023 and negative 0.18% in 2024. Lease rates reflect the cost of borrowing physical silver, and a spike in those rates is generally interpreted as a signal of tightening physical availability and reduced confidence in the certainty of delivery through paper channels. When rising lease rates coincide with widening physical premiums and a collapsing open interest figure, the combined picture points to a loss of confidence in paper-based silver settlement systems. The broader context framing all of these developments includes what has been described as multi-year supply deficits in silver, ongoing geopolitical fragmentation, and continued central bank purchasing activity in the gold market. The convergence of these factors, 10 consecutive green monthly closes in silver, gold's 7th straight record close, a $12 Shanghai premium, a 27% collapse in COMEX open interest, lease rates at 1.6%, and $650 billion added to precious metals market capitalization amid escalating geopolitical tensions, represents a confluence of data points that market participants are actively monitoring. Investors and analysts alike continue to watch these developments closely as conditions in both physical and paper precious metals markets evolve.